Hi guys. Uh, Today we'll discuss on how to read option chain, and this topic of reading option chain actually was due for last week, but due to some reasons could not take it up. And we'll try to see how we can decipher what are the support and resistance region in while reading the option chain for Nifty. So basically, Nifty is the underlying asset over here, and if you open the option chain of NSE, basically this is the link. So I'll paste this link in the comment section, and there from there you can copy. You will get this option chain window, and here you can see the expiry date. You can change the expiry date to different dates. So normally every week expiry date is there, and the month expiry date is there. So let's open the month end expiry for 30th April, and this is the current index level 8981, and here the timing is given, so you can refresh it every time and you will see the new data coming in. So the layout is as follows here. On the left side is call option. Call is normally used for when we are bullish, and put option is on the right hand side, normally used when we are bearish. Now this difference in color, if you are seeing, one is in slightly orange, another is in white. So all the options which are in this orangish region is in the money for call option, and similarly here for the put option, all the data in the orange region is in the money for put option. So what is in the money? In the money is basically, if we are looking at the index level here, 8950, 8981. So all the call options strike price which are above 8981, that's like 9000, 9050, all these are out of the money options. And similarly for put, since the index now is at 8981, so all the strike prices below 8981 will be out of the money for put options. As the index moves, starts falling down, these 8950, 8900, all these also will become in the money. And similarly, if the index starts moving up, all these strike prices 9000, 9050, 9100 will become in the money. Yeah, this is very important. Basically, most of the people don't know about in the money and out the money. So you should know which strike price is in the money and which strike price is out of the money. Now we see, there are a lot many columns here. So the first column is open interest. Second column is change in open interest. And basically, these open interest is nothing but as and when you are buying or selling, the number of contracts changes. So if you buy one contract, here it will reflect as +1. If you sell, it will deduct that contract from it. So this is a total number of open interest as a current date. This is the change in the open interest for today. So any open interest currently being made will be reflected here. Volume is basically whatever is these transactions in the open interest, it is getting recorded here. And implied volatility is for each strike prices will differ. It keeps changing in the day, and basically implied volatility signifies what is the possibility of that strike price to end up at the expiry. So if 30th April is the expiry date, so it has a 40% probability of expiring at 9000 strike price. Yeah, so currently volatility is high, so most of them are showing around 40% probability of ending up. So that's basically because of high volatility. LTP is the last trading price, so this trading price keeps on changing as we see in the day. Currently is 220 for 9000 strike price call option, and this also keeps changing. Net change is shown here. So this bid quantity, bid price, ask price, and ask quantity is of nothing much importance here. Basically, these are the data points, reflecting at what bid and what bid price the buyers and sellers are making the trade. Similarly, here on the put side, same things is there: open interest, change in open interest, volume, implied volatility, and LTP. So we'll discuss today only the open interest and the price. Implied volatility and volume I'm not touching for today because it will become a long topic. And while implied volatility is very important, we will discuss it on some other day. So what happens, when open interest increases and price goes down? We say it's call writing, right? On the call side, if you see, 298950 contracts got open today, and at the same time there was a negative change in the price. So basically, the price of yesterday was around something 300, more than 400 actually, and right now the contract price of 9,000 is 221 because we saw the market open gap down from 9,000 and it started going down. So there was a premium decay in this strike price. So normally when the number of contracts increases, change in the open interest is positive and the change in the price is negative, we say it's a call writing. And similarly, if the change in the open interest is positive and the net change in the LTP is positive, we say it's buying. So here the put buying was happening, since the index was going down, so people were buying put side. So put buying was happening on the put side, and call writing was happening on the call side. So normally this indicates a bearish sentiment in the market. Similarly, if we have the reverse happening here, high buildup of open interest with negative, change in the price, then we say it's a put writing, and positive change in the open interest with positive change in the LTP, we say it's call buying. So put writing and call buying indicates a bullish sentiment. So these two things, if you remember and you start observing in the live market, you'll come to realize that importance of these four indicators. When is call writing happening? When is put writing happening? If you start observing on a daily basis, you will come to understand it's of prime importance when we are seeing the market. And similarly, total open interest is shown at the bottommost part of the option chain, and total open interest for put side. So there is a something indicator called as put call ratio. So if you divide the total open interest at the put side by total open interest at the call side, you will get a put call ratio. And if that put call ratio is greater than one, most likely the market will stay up on. So as you can see right now, April expiry, the total number of put is higher than the total number of call option. So this indicates that the put call ratio is greater than one, and we will see the market will fairly be above than the last month's expiry. The last month's expiry happened around 8,600. So likely that this time also market will stay up. But let's see. That is the option changes right now bullish for April and expiry, but it can change. So we need to keep observing option change. There might be some changes in this week and next week, so it will change accordingly. And of course, the technical indicators that we are using to decipher what is Nifty movement, also to be used in tandem with the option chain. So for tomorrow, I think Nifty will touch 8,900 for sure. Today it tested 8,900 as I predicted in the morning video, and we can see that Nifty might test 8,500 if it crosses 8,900 with heavy volume. It will touch 8,500 for sure. So Nifty is currently in a downward momentum, and we can see the pressure coming in. Also, the US oil is currently trading at $11. So again, it was not sustainable at zero. It went up, started from $21, again went down. So we'll see a heavy pressure from macroeconomic factors pinning in the Nifty, and we all already have a pandemic problem, so not possible for Nifty to go up higher than 9,300, which was in last 2 days. So yeah, overall Nifty is bearish, and we will see some good movements in the coming days. All right, guys. Whatever we saw today in option chain, I hope you understood. Any comments you can type in the YouTube videos, and we will get to it. Thank you.